Hi guys, Happy New Year. Today is January 3rd, and this is Wyckoff Trading Course Part 2, Session Number 1. Welcome back to those of you who have taken this course before or many times before. And welcome back WTC 1 alumni. You have finished your first step in our educational curriculum. For you and with the basics and with some other concepts that are intermediate advanced concepts that you've learned in WTC1. Now we are stepping into the WTC2 course. I also would like to welcome our guests. This is a free session, so usually well attended. And with that, let's just continue into discussion of what we're going to do next. And as always, everything that we discuss during the sessions is for educational purposes only. Stop the recording and read the disclaimer in full. Some details of the course, as you guys know, for those of you who are alumni of the WTC2, and there are quite a few of you here, so here's your rate. And then for WTC1 students that are coming in fresh into this semester, for WTC2, want to remind you about the payment plan, which I think is a great option. 15 sessions as usual. Really quickly, for those of you who are students, you already guys know this. I would like to receive one file per homework, but there's going to be an exception. I want to ask you to give me one file per homework, which is going to be the bias game file. Plus, separately, I want you to send me the anatomy of the trade file. We will talk about the anatomy of the trade in the next session. This is just going to be for our group, the ones that sign up, but the bias game, we'll go through today. And as usual, the formats that I would like to receive your files in are PowerPoint, PDF, and Word doc. Also, don't forget about naming the file correctly. I apologize. It should be a WTC2, homework number 1, and obviously wyckofassociates@gmail.com. Addressing other questions, especially for guests, is this session being recorded? Yes, this session is being recorded, and we will put it on our YouTube channel tonight. Our YouTube channel is called Wyckoff Trading Method. What are we going to study? Well, I mean, obviously, we're going to have a lot of applications here, right? So this is a practicum. This is where we practice. So there's going to be a lot of drills and exercises. We're going to do drills and exercises in 2 ways. There's going to be a homework each week. So this is going to be extremely stable, like 2 assignments for you each week for sure, the bias game and the anatomy of the trade. And then we'll have some other assignments maybe spilling over, the classroom assignments. And then the second part of our drills and exercises is going to be in the classroom. I'm going to have some action sequence exercises for you, some bias game, exercises as well. So we're going to be practicing a lot of exactly what we've been studying in WTC1 course. Our bias is going to be, our concentration and focus will be on bias and timing. And specifically here, we will be going through 4 types of analysis. And we're calling this, and this is totally our invention here, bias analysis. So this came about as students maybe around 5-6 years ago started asking me a question, could you come up with the sequential step-by-step analysis of the trading range? And this is exactly what we've done here in the last 5 years. We're definitely still trying to improve that, so it's not completely done. So we're gonna go through the sequential horizontal analysis. We're gonna also go through the sequential vertical analysis. We're gonna go through the flashcard analysis. And we're gonna go through the quantifiable analysis. And it looks a little bit daunting, right? Like 4 ways of analyzing the trading range, but every way that I'm going to give you to study and to adapt for your analysis is going to be useful, and then you could decide, which way you kind of leaning towards. We also gonna talk about the differences between these two types of analysis, and you're gonna see the pros and cons for each. So that's gonna be our major part of the class each time. And then we'll talk about scenario building, trade management, a little bit of risk management, a little bit of selection. Some of the exercises will be on the selection. And then, more in-depth studies on like trend behaviors and trend analysis, variation on the volume signature phase behaviors, and into the end of the course, we're gonna be doing some optional coding, optional meaning that you don't have to do it at all. But some students that would like to do this, they will do this. We will be studying significant bar analysis, which is basically a part of the VSA. And this is just my personal adaptation on the volume and spread analysis and swing analysis. And around these two subjects, which is going to be the primary theoretical knowledge for this course, and I will be giving you the theoretical knowledge through this course, there will be some coding done with Pine script in TradingView. And that's basically our whole course. So I keep repeating for those of you who are returning back. Why am I saying this? Well, because there are quite a few people who do return back for the multiple attendance. From semester to semester, people kind of like migrate, to this class and stay in it. Why? Well, because it's a practice, and it's much easier to come to a structured environment where you are given an assignment, where you have the plan for 2.5 hours to immerse yourself into the analysis, where you are going to get some new ideas with each semester, because this is the course that is building itself up using students' questions and my answers, or using students' knowledge, and then we build on that as well. So it's kind of like our R&D shop that we use, even though it seems like it's an education, but it's a research and development at the same time. And that's why people come back, to practice, to gain something new. And for those of you who are guests and you are wondering, okay, well, yeah, I want to take this class. Well, not so fast. I'm sorry about this. You will have to take the prerequisite, which is the WTC part 1. And that's very, very, very important. Why? Because there is just not enough knowledge that I see in students that come to us. Some of you are saying, and even today I was answering some of the emails that were asking me this same question, like, could I take WTC2 without taking WTC1? I've done this before. It doesn't work. Unfortunately, somebody coming to me and saying like, yeah, I'm pretty knowledgeable about Wyckoff methodology. When we start talking about, advanced concepts, and there's no understanding there are a lot of blind spots, and what happens is this type of people start distracting the whole group, the whole class, asking very basic questions or intermediate level questions, and it just goes downhill from there. So I just said I will never do this again. So you might have read a lot of books, you might have been coached by a lot of other Wyckofians, but the material that we give in WTC1 is pretty unique, very much personally adopted by myself, to Wyckoff methodology. I'm not teaching the Wyckoff method, I'm teaching my adaptation of the Wyckoff method. And with that, you just have to take this. So what do we study in WTC1? Market structural analysis, volume and price analysis, relative and comparative analysis, trade management, and session number 15 is devoted to the Q&A session. You could probably go to our website, get more information. We just had our first class yesterday, so we just posted it on YouTube. Please go to our YouTube channel, Wyckoff Trading Method, and check it out there. And sign up. Sign up. Don't waste life. Don't waste time. Sometimes people come to me and they say, like, yeah, well, next semester I'm going to do this. Next year I'm going to do this. Well, why waste life? Just do it now. All of this, let's put it in the kind of like in some kind of box and wait. It just doesn't work that well. All right, so this is the curriculum for today. In next session, we're gonna finish the introduction. Then we're gonna go into our market update as usual. So as you guys know, so each class we talk about the markets, we analyze the market. Then we'll go into exercise number 1, which is based on 2 ideas of observations and deductions. And then we will review the bias games number 169 and 170. Your homework will be bias games 171 and 173, and I'll explain later on. We will discuss the anatomy of the trade homework, as I said, in the next class, once we're in a more intimate environment and we only have students. Oh yeah, I completely forgot. The reading assignment for next week, quantitative versus qualitative practices. Those 2 articles also will be posted in your student profile under this class. So please look at that, and I'm gonna just make it a part of your homework for next class. Okay, just trying to see, am I missing anything here? Okay, so here it is. Here's your homework. So 2 articles. The first one is not actually the article, but the chapter from the Malcolm Gladwell Outliers book, and it's called 10,000 Hours. So we're going to be talking about the quantification of our practice. How much time is it required for us to practice? How much time is it required for us to trade? And so on and so forth. And then mundanity of excellence. This is an amazing article on the Olympic swimmers and their trials for the Olympics, and it talks about the quality of your practice. And in the next class, we're going to have a discussion, and I'm going to give you some spreadsheets and tables how to approach these 2 ideas and how to quantify your practice and how to qualify your practice, right? It's going to be a very interesting discussion, so please be prepared by reading both of the articles. Again, they're going to be under the home assignment in your class page. So that's assignment number 1. Assignment number 2, bias games number 171, 173, anatomy of the trade, we will discuss in the next class. And you already have the instructions on how to access the class page. You should be able to do that. All right. Okay, market update. All right, let's do this. All right, guys. Well, as usual, I want to ask you, what do you think about the market? What is the trend? Write it down in the questions box. What kind of answers are we going to get in this class? Eric is saying sellers are in control. Yes, we're still in the downtrend. Lower highs, lower lows. Okay, long-term down from Thomas, medium-term trading range. Okay, long-term up, Vitaly is saying, and Vitaly is obviously referring to the secular uptrend since 2009. So we could say long-term trend is up, and that is the low of 2009. Intermediate, and I would probably go 2 ways here for the intermediate. definitely a down market for the whole year of 2022, right? And then more recently, specifically starting from May, right here, this is all trading range. This is just a big trading range. And then short term, and by short term, this is the last swing. Then where are we with the swing? We were trying to go up, and then we reversed the last two commitments to the upside with this bar on December 15th. And then everything else is below this bar. So the testing of this bar is happening lower. So T1 test. So for now, don't worry about these abbreviations. And we'll kind of go into this material once we're going to study the significant bar analysis. We're going to talk about the significant bars and the kind of tests. So T1 is just abbreviation for a specific test. That just basically tells us that the strength after the significant bar is quite sufficient. Is quite big. So this is where we are. So for the short term, it's down. And here's your definition. So secular trend is up, intermediate down to trading range, and then short term down. Okay. Is there anything that has changed? So in the last two classes, we've talked about how around the area of the resistance, we have had our touches of this resistance. And before we would touch, we would come back, we would go into the lower high, which could be also thought of as a test, and then we would continue to the downside. Touch, lower, lower high, continuation after the test. Touch, going down, and then there is no test, right? So if anything, we're testing the previous high at a higher level, which is an upthrust, an intraday penetration of the resistance of the local resistance, and then almost a touch of the long-term resistance right here. So this is one change. I just want you to keep this in mind. Something did change here, but we still making, again, I'm going to repeat this, lower highs and lower lows. This is a definition of a downtrend. So another observation here now on the opposing side. When we look at all of the reactions in the most recent trading range, what do we see? We see that the downward result is expanding. We're seeing that the selling or the effort rather is expanding as well. So the downward effort is increasing. So with the increase of the effort, we're seeing the increase in the result. Bullish or bearish? Definitely bearish. And definitely bearish, at least, short term. Probably the most common question, the most repeated question that I get, just recently, is all about the volume signature. Well, the volume signature is going down. So what does it mean? I've been asked. Supply is lower and demand is lower at the same time. How do we interpret this? And obviously, this is after the kind of like a very mandatory notice acknowledgement that we were during the period of low volatility due to the holidays. So the volume naturally falls down during those areas. The key here is all in the result itself. When you have the low volatility, what is the result of that low volatility? And we're still seeing that after the initial drop, what do? We're still having more of the bearish structure right here, where we can't really rally to one of the most significant lines in this whole trading range, which is our axis line. This axis line is so important. Look at the initial touch and support finding. Look at the break on the news. Look at the attempts to overcoming this, testing it, touching it at the support, breaking it down again, touching it again, attempting to overcoming, support, breaking through, and then attempts to retouch it again. How many times have we been through this line, up and down, up and down. And this is very natural, for any type of consolidations, any type of trading ranges. You are going to have this type of action. So you always want to define some kind of mean or axis line. David Weiss loved to call this an axis line, and then see how the price interacts around that. So far we are below this axis line. Well, if this is an important axis line for us to consider, then there is also a very important bar, actually a collection of bars, two bars. One of the most important up bars in this trading range is this one right here. This was a CPI report that pushed the price significantly higher, that overcame the axis line, not significantly, but still it did it. And then the down bar, which is also ironically a CPI bar, and this kind of like shows you how important the inflation numbers are for the Fed and the market reaction to the inflation and to the possibility that the Fed is going to go one way or another. And I would say that, very kind of like a very brute analysis here could be anything above the axis line is up bias, anything below is questionable, still down. It could be, and I'm going to show you some of the scenarios, where it could be up even if the price is down. But basically, this is how I would be thinking about this in very simplistic terms. Now, let's think about different scenarios. Obviously, bullish and bearish. So for the bullish scenario, I would say like, okay, so what is the higher probability scenario? Definitely bearish. Why? Well, because we are in the downtrend, right? So then therefore, we would be thinking about any type of possible continuations. We would be thinking that this is a potential redistribution. We're still confirming, I mean, like this move to the downside was still pretty sufficient. And we are definitely confirming this, at least for now, and redistribution to be confirmed or to fail. And I'm thinking about the analog here of 2001. You could also think about 2008 analog here as well. So let's look at both. And let's just remember the structure. First, we're going down, trading range, we're going down again. Then we have a big trading range. Okay, well, let's see how this unfolded, let's say in 2008. Well, actually, we could look at both. All right. So here is that first leg down, trading range, second leg down, and then we are in the consolidation. So I would say that currently this picture right here is more reminiscent and it looks more like NASDAQ. So we'll have to come back to this. And maybe in tomorrow's WMD class, I'm going to put both of the analogs and we're going to go through those. And we're going to use NASDAQ for the comparative purposes of with 2008. But with 2001, we're having the first leg down, trading range, second leg down, and then here's our stop in action. Here is our first change of behavior, which is suggestive that we are in the trading range. So think here to the current analog that this is May, June of 2022 price action, stop in action. And then here's our trading range. And one might say like, well, in 22, we actually, almost touched this level, this resistance. Well, you have to put 2001 into the context of what has happened here. There is a big overextension to the downside here. What was it? 9/11. Remember that time? Did I lose sound, guys? Can you guys hear me? Everything's okay? All right. Okay, back now for you, Diaz. Okay, great. All right, so 9/11 happens, and obviously here, that produces such an overextension to the downside. Whereas in the current 2022 market, we just produced a spring here, right? So we did something like this, and then we started rallying up, okay, and we almost touch here. So we are somewhere here at this point. So I would say that we are probably either here or here. It just depends on how we could look. So short term, we could go up, we could attempt to rally, and we will have to see what kind of rally we're going to have. So next, we're going to look at some bullish scenarios. But if we were to continue this bearish scenario based on the analog of 2001, based on the analog of 2008 for NASDAQ, then we should have a very swift, very volatile move to the downside. Here's this dramatic pause that I'm trying to produce here. So think about the opportunities that you might have here if this is to unfold. And please note, I do not make any predictions, but I construct scenarios. What if? What if this is to happen? And if this to happen, how would it look like? How would the price start failing? And how would the price, start showing us that there's going to be some kind of capitulation? By the way, this type of capitulation, both of those, would mean that we're going to go into most definitely some kind of recession. Now, if we would talk about the comparisons of the, let's say, US recession versus, anything else in the world, I would say that US will outperform and will be stronger. So therefore, I'm thinking that if this were to happen, this is going to be swift, this is going to be very aggressive, fast, short duration, but devastating. And devastating from the perspective of how the equity could be destroyed in such a short period of time. I mean, when we look at what happens, let's say from the points of where we're saying that maybe we are, right? Look at this, almost 30% down in 2002. And then here, let's just say that we're here, okay, to the lowest point, this is 40% down. So still pretty significant. And when I say short-term, Raj, I mean literally something similar to what we're seeing here, literally happening within a month or two. And we'll look into the details of both of the drops. But I mean, structurally, I want you to see that structure. I want you to see that first kind of like, deterioration of the price structure where we go into the downtrend. That's number one. Then we are in some kind of trading range, and then we drop. Okay, so where we are with the current market, possibly we are somewhere here. Possibly for Nasdaq, we are somewhere here. So this is one of the probably best scenarios that we could possibly have. Why do I say this? I mean, like obviously, I'm not wishing anybody to destruct their equity and, lose money in the marketplace. If anything, I'm trying to arm you with the knowledge of what might possibly happen as one of the scenarios. But I'm saying that this could be a very, very good market for us to make money. Because if we know how to trade it, if we see this opportunity, and more importantly, if this opportunity unfolds, we could make a lot of money very quickly. So I'm thinking about trading right now, as I keep explaining to you guys, to all of my students. as I'm not trading specific asset. I'm not trading specific time frame. I'm trading opportunities. If I see the opportunities where the price accelerates, increases momentum, increases velocity, how could I extract the most amount of money from the short period of time and make a good percent, and then just go and kind of like wait until, let's say, a bull market is going to start developing. And in both cases, it did. And we'll talk, if this drop is to happen, we'll talk about the characteristics of the accumulations here, because those are also very, very interesting and important. But we're not going to discuss it today. We just need to see if this is to happen. Okay, so what other thoughts did they have here? Yeah, let's look at the way of how this drop happens on the daily. So this is the daily chart. What do you guys see in terms of the character of how the price volume behaves? Is there anything here that catches your eye that you could say, like, yeah, if I see this, then I know that we are at least preparing to go down, or we're already in some kind of downtrend, or in some kind of breakdown, in some kind of capitulation? What do you guys see? And we'll definitely talk about the price, and we'll talk about the volume. Large volume, large spread to the downside. Yes, so volume should increase, and it should become climactic. Why it should become climactic? Because we would be going through the capitulation. And during the capitulation, we have both forces at work. We have the increase of the supply, as the weak hands cannot hold on to their positions and they sell. And then also we have increase of the demand as the value investors are starting to buy. So weak hands, value investors. From all of this is how we are seeing the volume spike, which is climactic. In terms of the price, spread increase, correct? So daily spread increase. And we're seeing this, right? So like look into this area right here. We're seeing how the average true range is increasing. Okay, so what else? I see your loan demand tails on the way down. Okay, yes, at some point, at every point here, we've seen attempt to buy the value. And obviously that fails every time until we actually come to the actual true final stop in action selling climax here. Breaking 985 with large volume. So there is some kind of break, yeah, you could see kind of like the break here and then break of 911 low right here, okay? Rallies are weak. I'm assuming, Eric, that we're talking about the rallies that are in this decline, right? So let's look at the rallies. This. Yeah, the rallies are weak, and we could quantify that a little bit, right? So we could say like they're short in terms of the distance. So the distance for the rallies is going down, and then the duration also is low. And the duration, the shorter duration is extremely important point, because think about why duration of those rallies is different. Let's say from this into 2 days, 1 day, 2 days, 1 day, 2 days, 1 day, 1 day, 1 day, 1 day. Why does this happen? Well, there is not enough demand to produce any type of meaningful buying for several days, weeks. Somebody comes in, sees some value, buys, and then the supply, is being introduced into that buying. So therefore, duration during those capitulation phases is extremely important. Look at this capitulation phase, which is the interim capitulation phase, not terminal capitulation phase. Again, you have the same type of structure here. Before, you see that the rally could take quite a lot of time, 1, 2, 3, 4, 5, 6, 7 days. And here you could have already like 3 days, 1 day, 1 day, 2 days, 1 day, and the same on the terminal capitulation. So duration is extremely important. Okay, so what else? Volume increases, the price goes down. We've talked about this extension of the thrust. Eric, you mean to the downside? Yeah, extension of the downward thrust. Yeah, okay. Well, yeah, definitely. We're kind of like, seeing after the breakdowns extension into the capitulation low. So all of this, so let's say like we're gonna see breakdowns, I'm sorry. We're gonna see increase of this downward spread. We're gonna see weaker rallies on low duration. We're gonna see volume increase and specifically supply increase as well. And all of this are characteristics of this environment where we're in the capitulation type of move. And please note that in 2002, that capitulation, let's say after this breakdown right here, it took some time, June and into July. So this is 1.5 to 2 months that we are in the consistent downfall right here. So it's not that if you missed the breakdown that you are done here, that you should not be considering going short, going into the cash position, and cash is always a position, protecting your assets, or maybe speculating with some inverse ETFs, or maybe with futures, options, trades, and so on and so forth. So then you start thinking about, okay, now I see the opportunity. Now I feel it. I recognize it. If it's going to come, I'm going to act upon it, right? So we don't know whether it's going to happen. Again, we're not, forecasters here. We're traders. So we're just following the market. But if this opportunity is to unfold, then what do I do under the if scenario? Then I think that a lot of money could be done on the intraday time frame and also on the short-term swing time frame. And here, in terms of the assets that I would be thinking of using for this opportunities, I would be thinking futures, options, cash position, for those of you who are long-term traders, and your cash position is basically the position that should be outperforming anything or any other positions if we're going down, right? And then what else? Inverse ETFs. So I would be concentrating then on this trade parameters: intraday, short-term swing, futures, options, cash, and inverse ETF. Okay, let's quickly look at 2008, right? And I'm gonna start this discussion probably with, let me do it this way. Let me quickly capture NASDAQ. Okay. Okay. So on the right, we have NASDAQ. Oh, how do I do this? Definitely need just to put this on the slide. Apologies for this. Oh boy. Okay. All right. So here is current picture of the NASDAQ, and let's just see if I could put the 2008 here. Well, actually, we don't need NASDAQ. We need S&P. Yes, here we go. All right. So I'm thinking that the current NASDAQ picture is probably more appropriate as an analog in comparison to S&P of 2008, 2007, 2008. We kind of see the same structure where we have the stop in action. Here's that first attempt to stop. I would say that the selling climax is more evident here, but you know, Wyckoff labeling could be slightly different, but let's just label it this way. Okay, one, sorry, two. I'm still on the vacation, so oh, it's been really hard to come back after this mini vacation. All right, so first stop in action at one, a rally into two, then a slightly lower low at three, and then up thrust and extension above the resistance at four. So far, so good, right? Then five, which is a spring. And then look at how NASDAQ after five is rallying, right? So obviously weaker than anything else, than S&P, the Dow especially, and Russell. So we're not currently producing the rally that we would want, right? So we're kind of going into the axis line here, which again is an extremely important line. So in the axis line right here is this. Do you see any resemblance even how the price rallies here, right? And then I don't know, somewhere here maybe. But we basically, this weakness is very, very similar to what we're experiencing here. And that's why I'm saying that it's kind of funny how for S&P, we probably should be using the analog from 2001. And for NASDAQ, we probably should be using the analog from 2008. Now, in both cases, we still have that big conclusive drop into the actual terminal selling climax, into the actual low. And in both cases, the characteristics of this drop is the same. I mean, the velocity of it, some differs a little bit. In 2008, the velocity was much higher than in 2001. I'm sorry, in 2002, but still, how it looked, expansion of the spread, expansion of the volume character, and the way the structure that the price comes out of that is definitely still pretty much there. Okay, so that was pretty cool. And we'll discuss this a little bit more tomorrow in the WMD class. For those of you who are not familiar with WMD, go to our website, check it out. A way more interesting question than the decline itself is going to be, well, what do we do during the trading range? And I think that if we're going to drop like this and we're going to have some kind of meaningful decline, again, like 40% decline here, that's just insane. I think that we should be thinking targets. Where could we go? That's number one. Secondly, we should be thinking about the next structure, price structure that is, for possible accumulation that would come after that. And in both cases, we had different type of accumulations. In 2008, we had the downsloping accumulation with the character of the volume signature diminishing into phase C. In 2003, and this is the extent of it, I'm not gonna go further into this, we had much flatter and more kind of like this apex type of formation, where the volume signature started to increase as the price approached the lower part of the trading range. One way or another, in both cases, intraday trading, let's say indexes, was one of the best solutions here in terms of extracting a higher P&L. Why? Because the spread, the volatility is still pretty high, as we know, right? So phase A and first one half of phase B is a pretty high volatility. Then look how the character changes, right? So we have some kind of shortening of the thrust here. That's number one. The selling starts to diminish. We see this from the supply signature. And then volatility starts to diminish here. So this is where we want to start switching from the intraday to more swing and long term. Okay, and that's the pathway if this scenario is to unfold. Okay, I'm kind of doing too much here. Shouldn't be doing that much. All right. Again, for those of you who want to hear more on this, definitely tomorrow's WMD. Now, let's look into bullish scenarios. So we've discussed bearish scenarios, bullish scenarios. Well, with the bullish scenario, there are only two scenarios that I see here. The first, which is probably more probable, is touch of support and then reversal. So how would that look like? We're still failing here, but as we go down, we kind of, go in with some shortening of the thrust. Something similar to like 2003, 2009 low, where the last leg down shows characteristically not a lot of supply and not a lot of selling. Now, it's already not necessarily fully there just because of how on December 15th we have this, and prior to that, we have the emergence of the supply. But it still could be, if this selling is going to be somewhat, weaker than, let's say, selling right here, or especially selling right here. If we would see that deterioration from 1 to 2 to 3, we might say that the conditions for a possible reversal might be in place. Then you have to wait for the reversal and to see that the reversal happens. I mean, a lot of the times what I see with students is that either some are waiting for the reversal but don't look at the preconditions in the background, and then others, on the contrary, see the preconditions and they start, piling up their positions to the upside, and that doesn't work. So you have to have both, the preconditions and then the reversal itself. And then from here, some kind of local change of behavior, test, and then as a confirmation, a local breakout. And then we would be saying that we're still in the trading range, but inability to continue to the downside is a bullish sign. So with that, we'll have to see if this is one of the bullish scenarios that could unfold. The second scenario here is just immediate continuation to the upside. immediate continuation. And I would say that this is probably a very low or lowest probability scenario for now. For now, we don't see how demand is coming in during this stop in action. We're still within the within the confines, within the boundaries of the high and the low of this very, very important CPI bar. So that's the one of the bullish positive signs. But if we break this level right here, then we're going to the support for sure, and we need to assess what kind of how we're going to get there. Are we going to stop at the higher low, or are we going to continue going into the lower part of this trading range? If we do go lower here, this is more bearish. This becomes more bearish as a scenario than bullish. So again, January is going to be extremely important for us to see. If we go up here, let me just clean this up. If we go up here, like in 2001 and 2, we need to make sure that we're not registering another lower high, right? So if we come to this level and then we're still going down, this is still under pressure. This is still a major lower high. It just has its own trading range right here. So we need to make sure that we are monitoring that. We basically need to overcome this line and this line right here, and preferably a cluster, the resistance cluster right here. So something like this, where we stay above the axis line, and then hopefully, overcoming this. Is it possible? Possible, but we definitely did not have the best rally right here compared to the previous rally. It's weaker compared to the previous reaction. It's weaker. And then again, we are kind of starting the new downswing with a lot of supply. So for the bullish scenario, either hold in here or hold in here, both should be the higher lows. And then, from this would be our kind of like a bullish scenario. Another stat that I could bring here is that majority of the years that were down, years that were significantly down, let's say like, what is it, 26% were down or something close to that, usually the next year plus 20% some, right? So even more than 20%. Would it happen this way this year? I don't know. We'll have to see. But there are also years like 2000, 2001, 2002, 2003, where we have multiple years to the downside, right? So something like this, and only after that we have some kind of up year. So that's a possibility as well. So we can't really like say like, oh yeah, 1 year down, so the next year is going to be a recovery. If we are in the pronounced downtrend, a multi-year downtrend, you will not have a down year, then the up year, then a down down. You most likely going to have down down down. So, and that's kind of like a big key there. And then you start thinking, well, under what circumstances are we not going to have a recession this year in 2023? And I don't know what should happen. I think that, for us not to have the recession, the Fed quickly needs to start going into easing rather than tightening. Because you look around and home construction is completely out. Home selling is out. Mortgage industry is out. Auto industry is out. And then we are starting to see some unemployment numbers to go up, even though unemployment, I would say, is still a pretty decent level. I mean, that's probably the only thing that keeps us from plunging into full recession. It's just that still majority of people are employed. But if we're gonna have an uptick in unemployment, that could trigger the recession, and once that could trigger the discounting by the stock market, and from there, the Fed will be forced to stop the tightening cycle and go into the easing cycle. Okay, so these are all of the scenarios. I mean, like, I don't think that I see anything else. Okay, thank you, Eric. All right, so let me think as well, what else? Yeah, let's go to gold really quick. So 356. So we've talked about the weakness here, inability to overcome the all-time high. We said that this was a change of behavior. We said these rallies were weak. So starting from this bar, everything is to the downside. Everything that you trade is to the downside. So pretty good call right there. William and I were discussing today this compared to this. Pretty interesting analysis. For those of you who would like, to check out our tape reading lab on Mondays, pretty good exercise right there. Then we said that all of this had increase of the supply on the way down, so still pretty bearish. The change of behavior showed really good character and presence of demand, but it didn't break the structure of the downtrend, as you could see. So even though it acts as a change of behavior, suggesting a trading range, after the stop in action, we still, in the downtrend. Then we started comparing these three bars off the low right here, and bar number 3 definitely shows the expansion of the upward result and the expansion of the upward effort. So synchronicity between those two usually is suggestive of the rally. And we said this rally now not only will break the downtrend structure, which is the downsloping resistance, it will also break the trading range structure and will extend above. And that's exactly how it happened. In between the tests, all of the T1 tests were pretty cool. Extension was pretty cool as well. Then look at the diminishing supply character and the sprint type test, also suggesting that there is no selling at the support. There is only intraday attempt to commit to the downside. And we said that we're going to overcome this local high, which we did. Extension here is still pretty good. And then something interesting happens here in this area. What do we see? We're seeing that supply still comes in. There are a lot of supply spikes in this area. Even on today's bar, we saw some supply, and we see that supply tail, supply tail, supply tail, supply tail. We're seeing also the expansion of the spread. So kind of interesting how in this scenario we see diminishing demand and diminishing supply. And we're seeing how in both cases, the upward spread is diminishing and the downward spread is diminishing as well. And this is one of the difficult, analytical kind of like exercises that students come to me with and asking like, well, how would you interpret this? And you really, really have to think when the volume goes down in general, when you're seeing that both demand and supply are going down at the same time. The main idea is going to be always about the background. What is the background and what kind of result is happening during this area? Well, the background is obviously to the upside, and the result of this whole small trading range apex with a lot of volatility up and down is still to the upside. So therefore, the resolution here should be to the upside. And I thought that this test, the last down bar on such a small volume signature, was a really good testing bar for us to come in and to establish the position right here as a continuation. And this continuation could fail. I would say like my stop loss is probably somewhere here right now, would be here if I would be in this position. I was not trading this. Now, how is that compared to this area right here? So here it's slightly different. We're seeing that supply is actually increasing, demand is decreasing. And we're seeing how the downward spread is increasing, and therefore downward result is increasing. So this is more in line with the downtrend. And what is the background? Down. That's it. And that was the kind of like the difference between those two. But it was fun to discuss. Okay. And I would say that gold is definitely bullish at this point. We are in the middle of the range, but look at how in the prior instance, being in the middle produces this very quick rally to the upside. Look here as well, the same climactic run. So my argument today to William was that, it's holding really well, which William also was confirming. And his thought was that there is no reason for the price to come back to the previous support level just because it's holding so well. Extension here, hold, extension here, hold. So could we potentially have another climactic run into the same area? And I think this could be an opportunity. And I always start thinking, if this is to happen in gold, what does it mean for the market? What kind of opportunity the market would have? If we're going up, like for instance, this move up happened at the beginning of the year into February. What was happening in February with the market? Was going down, right? What about here, July of 2020? Remember we had that June-July consolidation? And here is that climactic. So this is a redistribution in the market. This is the first leg down. Could this be the last leg down, terminal leg down for the market? So that's kind of like my thinking here, what if scenario. If the market is going to go into some kind of terminal final leg to the downside, could the gold actually have a climactic run to the upside? Would be interesting to see, but I think at least we are given the license to trade here, to trade, I would say like short-term swing. I'm not necessarily thinking very, very long-term, although you could probably have cash positions in stocks. I would definitely be looking at the miners and would specifically look at silver miners. Okay, hold on a second, guys. Okay, Eric is saying, doesn't sound like a soft landing. So it's kind of interesting. And again, I don't want to just go into overall discussion about this because tomorrow, Bruce and I will be discussing a lot of this. So soft versus hard landing. Kind of an interesting idea. And as I said, I think that US still will be in a soft landing. But this doesn't mean that there's going to be no destruction, right? But with some kind of stock market temporary destruction. And the reason why I say temporary is just because I probably should say swift, like very, very fast, right? So the pain is going to be fast, but the recovery is going to take some time. Also, I think it's going to be dependent, and this is where this variable is always like, it's a known variable, but who knows what they're going to do, the Fed. How are they going to react to this? Are they going to react fast, or are they going to react, slowly? And then again, Eric, it just depends on the if scenario, if this happens, right? What if it doesn't happen? What if we still in kind of like this inflationary environment and they're going to keep the rates up? Okay, let's go to Bitcoin. We're at 405, so I'm going to speed up a little bit. So looking at the long-term picture here, we're still pretty much in the downtrend. Oh, that was not even close. Okay. Something like this. And we are interacting with the 2017 high. I think that the next important high for us is 2019. And what I'm thinking here is, could we possibly, maybe even lower, let me just see. This access line maybe right here, yeah. I mean, if the market collapses, could the Bitcoin collapse as well and go to the lower part of it? Yeah, absolutely. That's a possibility. But also I'm thinking, in a more bullish scenario here, could we go to, let's say, 13,000 and then start recovering from there? I think the key under this scenario is just to look what the overall market is doing. That's number one. And then how does the reversal happens in this area? Also, with the Bitcoin, what's important, extremely important, is this, the access line at 18.6. And basically, like with the S&P, anything above that is in up bias, anything below that is still down bias. And that's how I view this. Now, one more extra point here, which is extremely important. This collapse on the FTX catalyst is extremely important. There is so much volume right here. So if we were to, let's say, even if we go down and then we recover, we need to go with a lot of strength through this area of the previous breakdown. We need to have some kind of stupid up bars on significantly increasing volume signature, significantly increasing demand signature. Why is that? Well, because we need to see that institutions are coming back with urgency into this market. They know that, from here on, we are going to have the up bullish market. If we don't see that, if it's all tentative, like something like this, then it's still under the question mark. Then we still need to have a proper testing, overcoming that, and so on and so forth. So hopefully, we're going to see a more decisive move up if that happens. But prior to that, it still feels down. The trend is down. The short-term background is down. Low volatility, low volume is suggestive of the continuation of the previous background, previous trend, which is what? Down. So far, still down, down, down. We don't see anything here that would attract us, to the upside. Okay, I think that's it. Yeah, 409. Okay, great. All right, so I've been mentioning the Wyckoff market discussion with Bruce, so here it is tomorrow at Wednesday at 3 p.m. This is not going to be a free class, but you're welcome to sign up and to attend. Each Wednesday together with Bruce, we go through the current market analysis, something similar to what I've just did, but only better. Why? Because Bruce brings so much of his knowledge, accumulated knowledge, on the market, and his take on the market is always pretty interesting, very insightful, and Wyckoffan. Then we go into the stock selection. So we do our top-down approach, whether this is for the bullish scenarios or for the bearish scenarios, we do both. And then sometimes from time to time, we would do some additional segments of students' charts, of the anatomy of the trade, and scanning. For those of you who trade stocks, specifically US stocks, check out our Wyckoff market report produced by Johnny Scan. John releases his report each Friday. And what's unique about John's scanning and his report is that it's a contextual scanning. So he uses the stock charts scan engine to scan for Wyckoff events. And then we have each week some kind of look at the health of the market through the prism of Wyckoff events. So pretty cool. So check this out, sign up. All right, now let's go into our material and then let's go into the first exercise. And be prepared with the exercise to engage with me as usual. And obviously our WTC1 students are gonna help out. So let's talk about the main issues for trader students in their analysis. I see two big issues, and it's based on, what is it now, 12 years of teaching this material. This is going to be, again, I was trying to calculate, to count, I think cycle 37 for me that I'm teaching this material, WTC1, WTC2. So I've been around. I've seen a lot of students. I've seen a lot of traders. I've talked to a lot of students. I've talked to a lot of traders. The biggest two problems for the beginners and intermediate traders is to make the correct observation about the chart and how the market participants behave on that chart. And then after that, to make the correct deductions about what market participants' intentions are in terms of the bias, time, and the character of how they are perceiving the next move. Under the observations, trader students generally lack observation skills. Now, I don't necessarily want to say like, oh, it's just traders, it's just students. No, it's just us. It's just all of the people. We are just, incapable. Our minds are incapable of retrieving the information that we actually observe. We might be observing, like, let me ask you this question. You're probably sitting right now in some room. Could you tell me, in the room that you're sitting right now, how many items in front of you or around the room do you have? Like, how many books do you have? What is the number of, I don't know, maybe like, pens, pencils on your table? What are the colors of those pens and pencils? What are the names of the books? What are the colors of the books? What are the dimensions of the room? I mean, I can go on and on about this. There are so many variables with in this in this room that you could find, right? So this skills to observe, to see what's around you, is hugely underdeveloped, extremely underdeveloped, just in us as humans. We also observe in a very non-objective way. Usually our attention is going to be caught by, on the chart especially, with some kind of big event, right? So some kind of shakeout, huge volume signature. Right away, students' minds are going to that particular bar because it attracts unconsciously their attention. And there is no objectivity to what has come prior to that bar and what has come after that bar. And sometimes we're just incapable of observing a huge number of data points. So for instance, if I'm going to give you just one bar with the high, low, open, close, and the bias for that bar, that's already 5 variables. I could extract the secondary variables from there. For instance, the distance between the high and the close, the high and the open, the low and the close, the low and the open, the extension of the spread from the high to the low. Those are all secondary data points that we need to extract in order for us to understand what's going on. Then we could start deducing there, like, oh, okay, maybe the tail on the top is smaller than the tail at the bottom. What does it say? What kind of deduction we could produce from that, right? So it's just a lack of observational skills overall that I see in students. So in this class, and obviously with WTC1 as well, what's important for us to establish right away is the way how we observe data points on the chart. Extremely important. Then after that, we go into the deductions. And again, with that, the interpretation of your observations, could be incorrect, not systematized, and there is no weight of evidence, on the specific event. And that's why with our bias games, again, starting with the next class, I'm going to be giving you step-by-step sequential way of how you have to think about the analysis of the trading range, where the weight of evidence is going to be on the specific events, on the specific bars, on the specific swings, on the specific price structural characteristics, or just characteristics of, let's say, the price and volume relationship. Okay, with that, Raj was saying we did this exercise in WTC1. No, we did not, Raj. Okay, did we do this? No, Eric is saying no, we did not do that. Okay, so here's your exercise number 1 for this course. I'm giving you data points. Oh, the room analysis. Okay, yeah. You need to do to give me all of the observations that you could make. I'm gonna be, we're gonna go from left to right. Yeah, Wyckoff story unfolds from left to right. We're gonna put all of the observations, and then we're gonna talk about deductions of those observations. So let's start with bar number 2. We're not gonna start with bar number 1 because we don't have anything there. Although we could make some observations. Let me make some observations. So, for instance, I was talking about, let's say, observation of the distance between the high and the close, the low and the close, and we're seeing that the demand tail is a little bit better than the supply tail. So we would be thinking that demand is trying to rally here, and we're seeing that this is a down bar right here. So probably, maybe, I'm assuming that there is some kind of context of maybe going down here, and then we have the bar that is attempting to rally. If this is the case, then this rally is not that great, right? So we are not producing a lot to the upside. So let's discuss bar number 2. Give me all observations for bar number 2. What do you see there? Large spread, yes. So the downward spread is increasing. Okay. Breakdown, correct. Increased spread, increased volume. So volume is increasing, and therefore we could say supply is increasing. Okay. All right, increased effort to then result to the downside, increase in volume. Down bar, large spread, demand is trying to stop. Yeah, there is some presence of the demand in the tail that we're seeing, plus some demand is coming in. Okay. Increased volume, increased selling, some demand is coming in. Okay. By the way, right away, let's kind of like talk about, by the way, nobody says there is a gap, right? So gap, therefore open. At the open, which is lower, right? And we are opening into the low, into the previous bar low. Right away, let's make some deductions here. What does it mean at the open that we have this type of weaker open? What does it mean for the bar? What does it mean for the whole day there? Increased momentum. Vanessa is saying, I was probably thinking, Vanessa, more about the bias for the day. What do you think, like if we are opening like that, are we gonna have more of the bullish day or more of the bearish? Yeah, bearish, more of a bearish day. Bearish day continuation. So right away here, we are making that observation from multiple points, right? So we've talked about bar number 1. We said that demand is coming in into the close on bar number 1. And then this is not a great rally because this is a down bar. So therefore, opening even weaker is suggestive that we're going to continue to the downside. Now, I think Eric has mentioned that there is some demand that is coming in. We've seen this in the demand tail at the end of this bar, right? So here it is, increase of the demand. What does this mean short term? What do you guys think? Some buying, yes, Stanislav. Vanessa is saying slowing down possibly, correct. So we're seeing demand coming in and stopping the selling, at least temporarily. And that is suggestive that, okay, maybe there's going to be attempt to rally. Do we have that attempt to rally, let's say on bar number 3? Do you see that? Okay, Ken is saying yes. Where do we see that attempt to rally on bar number 3? Upper week, correct. So we open, and I would say that, this could be, bar number 3 could go either way. I would usually go with the momentum of the open, right? So from the close, this is the close, to the open, we are gapping down. So I usually would say the first momentum is to the downside as a continuation. Then we're going up, rallying up, and then we're closing down like this. So it's almost like we are producing some kind of stopping action, then we are rallying, and then we are testing into a slightly higher low into the end of the session. And it's very interesting how the volume, what could you say about the volume on bar number 3? Spike, high volume, but small spread, divergence highest. Yeah, so the highest volume signature, and then the extent, let's say like if we would make a secondary observation here, from the low of bar number 1 to, let's say, the close of bar number 2, this is the progress that we have made for the session. Below the low of bar number 1. Then below the low of bar number 2 into the close, this is the progress that we have made. What is happening with this result to the downside? Shortening of the thrust, correct. And shortening of the thrust usually will be associated with what? The emergence of what? Demand in this case, or we would say opposing force, in this case, demand, right? So this bar number 3, the volume signature, this whole volume increase, we would write something like this: volume spike, the dominant force is still supply because this is a down bar. So supply is increasing, but the opposing force, which is demand, is coming in. And WTC1 students, okay, so what should we think about when we see the opposing force to come? What should happen next? Stop in action. What else? Change of behavior. Okay, trading range or reversal. Okay, so we know when the opposing force comes, at least temporarily, we should have those elements. Temporarily, we could stop. Temporarily, we could have a change of behavior. Temporarily, we could go into a trading range or reverse. And we do exactly that. Okay, so we know that the demand is coming in, and we could, on bar number 3, and we see this also in the intraday tail, which does what? It basically shows us the capacity of the price to travel up and to negate almost the whole true range of bar number 2. So intraday tail shows some kind of strength. Okay, great. So from here into bar number 4, what do we see there? I'm probably going to erase this just for us to have a cleaner picture. Okay, bar number 4, your observations. 50% of the previous candle. Okay, confirmation. Okay, gapped up at the open. Yes, so from the close to the open, gap up. So, and we have not seen this, right? So in a way, this is our change of behavior from bar to bar on the bar level, right, Ken? Okay, what else? Effort versus result, less volume than 2 and smaller spread. Jim, this was such a great observation. I just really wanted to go there. So look at how the volume signature at 2 and 4 are somewhat the same, close, right? So effort at 4 equals effort at 2, somewhat. And yet, what could we say about, let's say, the extension from the open to the close, from the open to the close. I would say slightly less, right? Slightly less. And by the way, what does it mean? What kind of deduction could we produce here? Could we make? What is moving easier? What is moving the price easier, supply or demand? Ever slightly, supply is moving the price easier in the downward uh, um, direction. So it's kind of pretty cool. Let's just put it down. Supply moves price slightly easier. Okay, if that's the case, and we're seeing this in the first leg down and then in an attempt to rally on bar number 4, I'm going to ask you here the question that is going to be ridiculous, just to think that we could even conclude the bias for the whole formation. But at this point, just based on that observation, what is the bias? Do we compare closes between 2 and 4? Yes, we're comparing 2 and 4, Eric, in terms of what? In terms of how much volume, how the same volume moves the price up and moves the price down. Does that make sense, Eric? Yes? Okay, good. Okay, so yeah, all of you are saying bearish. Could this be our flashcard solution to this? I don't know. Let's see. To be confirmed or to fail. But sometimes those type of things, they kind of very telling. It's just that, have you even thought about this when you looked at this chart? Majority of people, 99.999% of people would not do that. Yeah, and our goal here obviously is just to make sure that we do. Okay, bar number 5, what could we say about bar number 5? What does that look to you guys, bar number 5? Is this a significant bar? Is there some kind of extension, or is it a test? Probably a test of 4. And what kind of test is this? Is this a successful test? I mean, everything happens above, or majority of it above the close. Above the close of number 4. And therefore we could say, yeah, it's successful. What's happening with the volume? Volume is going down on the test, so that's also very good. So with that, with the test being above the bar number 4 close, with the volume going down, what's the deduction here? Is this a good test or bad test? Well, we're going to have some kind of continuation or not? Yeah, so a good test, T1 test. And the conclusion here is that, well, T1, we should say this in observation, and therefore the conclusion is that there's going to be some kind of continuation, at least for now, of the current rally. Okay. Correct observations, lead to correct deductions. Okay, bar number 6. What happens at bar number 6? I'm just gonna make a couple of the observations. I'm gonna say that the volume signature at 6 is ever slightly or the same than the volume signature at 4. And then we probably would be comparing the spreads here, right? So pretty hard to figure this out by the eye, it looks to me that the spread is ever slightly less. So the upward spread of 6 is ever slightly of the same as the upward spread at 4. Okay, let's see what you guys wrote. Okay. Ease of movement to the upside, demand is increasing, climactic run, similar spread as 4 but less volume, fails to commit above local resistance on increased volume, sign of strength as a question mark, failure to commit above the high of number 1, cannot close above 1, closed above bar number 2, failure to commit above gap. Okay. Yes, there is definitely. Gosh, now I look at that and I'm thinking, like, is it increasing spread or decreasing spread? It looks to me a slightly decreasing spread, yeah, between the low and the high. Yes, we're not necessarily committing above the resistance, right? So the close is still below. And I think it's going to be even more telling when we go to bar number 7, because there is immediate rejection right there. You know, we can't overcome this bar number 1 high, and we can't overcome this resistance. And the volume signature, you know, is definitely high, let's say, than bar number 1. So therefore, there is some kind of, yes, it is bullish, and this whole bullishness was produced, you know, started with the tail of bar number 2, the supply tail of bar number 3, showing that the intraday capacity of the price to go up into the higher low test, and that's what set it up. So there are preconditions that are happening before the actual move. And that's what, as analysts and traders, we want to see. We want to see that change. And remember that I always would say change takes time, right? So it took 3 bars for us to get to the setup that we want. If we were short-term traders and we were seeing this and we would be trading it, you know, to the upside, where would be our target? Just the resistance. And we definitely, you know, there, right? We came there. Okay, bar number 5, effort more than the result, early indicator of issues. We usually don't look at, and we don't necessarily compare in the, okay, well, let me rephrase this. At 5, bar number 5, okay. Effort more than the result. This is a little bit more complicated to answer, because we would have to go, and we do that with the significant bar analysis. We have to go into the ease of movement determination to see what kind of progress we have on the decrease of effort and the decrease of the result to the upside right here. Again, this is a free session. I kind of like trying to avoid to give some of the information here, which we will be studying at into the end of the semester. But we will be studying the ease of movement of each bar, and we could compare one bar to another to say, are we actually decreasing the strength and the result, or are we, on the contrary, increasing it? All right. So apologies that I can't go there. All right, so bar number 6 is showing to us that the volume, let's say, is somewhat the same as 4. The volume, the spread is somewhat the same, but no commitment above 1. And I'm so happy that all of you guys, you know, WTC1 students, you guys are noticing this. We've talked about this. This was such a big deal for us in WTC1, right? How I was drilling this into you, that you always have to look at the result. Like, what is the result? And we didn't have that. Okay, bar number 7. Pretty big bar, right? So I would say this is not necessarily, I think 3 is the largest spread, but this is also, this is the largest spread between open and close. on any of the down bars. Okay, largest down spread between open and close. You guys see that, right? And then what happens with the supply signature at 7? Volume increase. So therefore supply increase. Okay. Effort high, result high, increase. Okay, upthrust price rejection. Yes, there is an upthrust right here as well. Also very important point. Price rejection above resistance and closes near the lows on increased volume, closes below the low of bar number 6. Yes. Thank you, Jim. Yeah, so we are committing at the close lower because the close on bar number 7 is below the low of bar number 6. So reversal, right? Okay, and then bar number 8, really quickly. And by the way, all of these observations, bullish or bearish, as the deduction. Still bearish. Okay, and bar number 8, can we confirm this bearishness? A test, Roger saying yes. I like that. What kind of test are we having here? Demand slightly stronger than supply. We are trying to rally here. I see your point about the tail. Yes, the two tails are different. But don't forget about the immediate background, which is to the downside, right? So it's an attempt to rally. It kind of reminds me of bar number 1 a little bit, right? And then if we would be comparing 1 to 8, what could we say? There is slightly more volume on bar number 8 and it's lower close. So in a much more vulnerable position right there. Okay, so is this a strong rally? I mean, like demand is coming in on this bar. That's how we should be thinking about this. Is this a very strong up bar? Probably not, right? So we're gonna say weak up bar. And on the background, which is still to the downside. Okay, so what is your conclusion just based on all of these bars that we went through? And we've created the Wyckoff story from left to right. What would you guys say is the bias? Bearish, 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 bearish. No one is bullish. Is anyone bullish? Let me ask you this question. Okay, one bullish. Okay. Okay, Lowry. So what's the argument there for being bullish? Hassan is also saying high or low, maybe bullish. Lowry is saying the correct thing because everyone is bearish. I love that. I love that contrarian thinking. Wyckoff methodology always deals with the price analysis at the point of the contrarian sentiment extreme. So it is definitely in our forte, you know, to go to that sentiment in indicators, like whatever is, if everyone is bearish, I'd rather take the opposing side. But one of the things that we need to do, we need to make sure that we support our bearish bullish sentiment with the correct technical interpretation. And as we go from one bar to another, and let me just quickly review this. Bar number 1 is down, attempt to rally is weak. Opening on bar number 2 still suggestive that we are going to go to the downside. And by the way, guys, we forgot to do the swing analysis as well, because there is swing number 1, swing number 2 here, and swing number 3. Then some demand is coming in. Some demand is coming in on 3. Shortening of the progression to the downside is suggestive that we're going to have the rally. And 4 is so nuanced, but it just visible, kind of like visible here, even with the naked eyes, that the upward result at 4 is diminishing on the same type of effort as bar number 2. So we're seeing that selling is still stronger, even though we are rallying. Bar number 6 does not allow us to commit above the resistance, and bar number 7 sees the emergence of the re-emergence of the supply, and more importantly, ease of movement with which the commitment is made below the low of bar number 6. 8 is just confirming 7 in the inability of the rally, of the demand to produce a significant rally from here. And that's it. So definitely a bearish bias. And indeed, after that, the price went down. Under the swing analysis, and this is something, again, I forgot kind of to mention, what would you say? Is this swing number 1, better than swing number 2, which is to the upside? Which one is better? Which one is more in control of the price movement? Number 1. Why? Why would we say so? Only 3 bars. Okay. Well, we kind of seen like, yeah, 4, 5, 6 there. Okay. Increasing volume. Agreed. Look at that. Look at the volume of the supply and look at the demand, right? So supply is still dominant over the supply. Supply is still dominant over demand. Okay. What else? Volume similar between 2 and 7, candle 7. Okay. Yes. I would say the verticality of this is a little bit more than this. This looks a little bit more laborious than this. There is some kind of ease with which the price goes down. The gaps are much more substantial in terms of how the price opens. Here we see smaller gaps as well. And then just the look of the aggression to the downside is a little bit better for the swing analysis. Okay, so I've only given you 8 bars. How many data points did we discuss? I mean, each bar is going to have your open, close, high, low bias, right? So this is primary data for the bar. Now, then we're going to extract secondary data, right? So we're going to say, okay, what is the gap data? What is, let's say, the distance between, let's say, open and close, high and low in terms of the true range? Then any type of shortening of the thrust results. Then we said in the primary data, so this was, if this was price, volume, increase, decrease, supply, demand, and then the difference for the specific bars in the volume signature. Okay, then we also extracted intraday data. And that usually in the construct of the session. And then secondly, also, any type of intraday tails. So that was important. And then a bunch of secondary data here as well associated with this or this or this. And then only after that, we go into the deductions. So there are quite a few data points that we either observing or originating ourselves. And that's only from 8 bars. And one might be thinking like, oh, it's just 8 data points. No, it's more, way more, way more than you think. At least double it, because you have your volume signature data there as well. So that's ×2. Then you are going to have all of this price data, volume data, and then intraday data. And then you have your secondary data that you extract and just, based on the observations of certain concepts. So you might end up here observing in 8 bars close to 100 data points. Swing data too, Eric is saying, absolutely. Add that to the list as well. So I'd say, 100 data points. When you look at this exercise, I want to ask you this question, and you don't have to answer me, just answer yourself. Did you think about 100 data points when you look at this 8 bars? When you looked at this, did you go like, oh yeah, it's probably going to be around 100 data points that I need to think about here? And that's the problem. Just our minds are not built like this. And the whole idea behind all of our classes, starting with WTC1 course, is just to develop that understanding that we need to be better observationalists. And that's our step number 1. And then obviously going into deductions and making correct deduction using the correct deductive reasoning, or deductive reasoning rather. Okay, you thought that 8 points were so many points that we need to observe. How about a whole chart with the 100 bars right here? Wow. This would mean that we're probably, if we were to do exactly the same analysis bar by bar, that would probably multiply our data points by a factor of 10 around. I'm just speculating. I'm not just really kind of like going into the extreme correct count here. Jim is saying it's extremely challenging. It is extremely challenging, but it is possible. Any type of craft, I mean, like whatever you guys do, let's say like you are a doctor, maybe you're a surgeon. I mean, let's just take the appendicitis operation. My dad actually was a surgeon, and he is a teacher right now at the Medical Institute. And I've asked him once, and he's a gastrosurgeon, so it's everything related to our abdominals. Appendicitis, it seems like a simple operation. So could you tell me about the steps? And then as he tells me, I'm like, really? Is that simple? It's not simple. You have so many steps, and you have to think about this and this and this and this and so on and so forth. And it seems like it's a simple procedure, simple operation, but no, there are so many variations or complications that could go around. The initial kind of like intake of the patient, like what's the condition there? Is it already bursting? Is it like, still just pain there, and so on and so forth. And for those of you who went through this, I have. So you kind of probably remember all of those questions, all of those things. So the doctors are collecting information from you, they're doing some tests and so on and so forth. They're collecting the data points, observations. Then they're making some kind of deductions. Yes, we have to go in. And then once they go in, there are variations on how it's going to go, and so on and so forth. So I'm obviously, maybe it's not the greatest analogy here, but I'm just saying that we are constantly in any craft bombarded with observations and with the data points that we need to observe. So therefore, here's our job. It is challenging, but we need to train ourselves, to recognize this. Okay, let's do this exercise again. Kind of saying you're funny. At my level would be tough. Yeah, I like the comparison to the lords as well. I mean, like any type of craft that you do from 9 to 5 beyond trading, it's going to require you, if you are, a high level professional, it will require you, to think at that, type of level. And if you want to be profitable in trading, then you have to be a high level professional with trading. Okay, observations. I would say this, I'm going to lead you here a little bit. I'm going to be asking you specific questions. What is the trend that you see here? Definitely down. Okay, why is it down, by the way? I mean, like, why do we say that this is a downtrend? Lower highs, lower lows, And then, yes, we do go into a consolidation right here. Okay, so what else could we tell about this? What kind of other observations could we make about this downtrend? Let's talk about the downtrend first. How many legs of the downtrend do we see? 3. Correct. I would agree with this. 1, 2, and then 3. And then in between, what do we have? Smaller trading ranges, right? Okay. What are the most important bars on each leg of the downtrend? Bars with high volume, breakdown bars, correct. Leg out of the trading range, yes. So here are the 2 most important bars here. Here's the breakdown bar. And then we probably would be thinking this here. Okay, right away, let's make observations about these bars. What is happening from 1 to 3 on the breakdown bars? Spread is decreasing. Downward spread is decreasing. Okay, agreed. Diminishing thrust, shortening of the thrust. So shortening of the thrust, we mean when the breakdown happens, the extension, let's say either into the close or into the actual low of the swing. Okay. And we're seeing that in case number 3, definitely there is a shortening of the thrust. Right away, deductions about this. What would be the deduction around that point of time? Stop in action, correct? Meaning that we could go into the change of behavior into the trading range, which we did, okay? Does the volume confirm that this is a stop in action? Yes, right? So maybe a climactic stop in action right here. Okay, interesting. Right away, we see the change of environment. Is it helpful for us? Well, if we've been trading to the downside all this way, then we know that at this point, demand might be coming in and we might be in some kind of trading range environment. Okay, same happened here, same happened here. For those of you who are, you are curious and in your mind you're talking to me, which is great. I want you guys remember, and I'm talking to the guests right now. I'm not talking to the students. You guys know what I want from you. Whenever we go through the exercise and I keep asking you questions, you are talking to me, right, in your mind. You are having this internal conversation with me. I'm asking you questions, you're answering. You type in if you want, or you just answering. That's your exercise. This is the way how we work in the classroom. So do we have any type of stopping actions? Yeah, small ones. There is really nothing there that would say like, this is terminal stop in action. So we only see this here, where after that, we are prolonging the trading range. And we're seeing some kind of better attempts to rally than, let's say, this or this or this. Yeah, this is better. This is better. This is better. Okay. Now, demand is coming in. We're going into a trading range. What do we need to overcome in order for us to see a change of behavior? Okay, we had a change of behavior to the upside. I mean, like, okay, I'm gonna be here, asking you this question. Volume is diminishing, meaning that both supply is diminishing and demand is diminishing. Isn't that bullish? Diminishing supply, isn't that bullish? Okay, and a lot of you are saying yes. Okay, Eric is saying background is important. Eric, what is the background? Please remind us. Bearish. With the background that is bearish, guys, and please pay attention to this. I've repeated this today already probably 3 to 5 times. Okay, so speaking about observations and retaining the information. If the background is bearish and volume signature is going down, meaning that supply and demand both are going down, what is the main question that we would be asking here? Volume is going down. What is the result? Right? And then the question of the background. Those two questions. What is the background when the volume is diminishing, and what kind of, this diminishing volume with this background, what kind of result are we producing? Okay, let me re-ask you this in a different way about the result. What would be the most bullish result here, like a change of behavior type of result to the upside? Need to go above first resistance with volume test and then continue. That means change of behavior from Vanessa. Yes. Vanessa, would I be correct? Stanislav is saying sign of strength bar, sign of strength from Eric. Yes. So some kind of rally that would resemble a sign of strength rally, maybe with the sign of strength bar, preferably, on the increasing volume signature that would say to us that demand is increasing, right? Not only that, this would just produce a change of behavior, but could it be negated? If the price comes back to the support, immediately would be negated. So we need to hold here as a test, which equals the backup action. And then we need to go up, and on the local breakout, this would act as a confirmation. Do we have that? No, or not yet, right? So therefore, what do we trade here? Still, the background, which is still bearish. So we can't overcome this last breakdown, and that's what's so important. Attempt to overcome, attempt to overcome, attempt to overcome, multiple attempts to overcome, and look at the latest attempts. They're much, much lower in the lower part of the trading range. Still weakness. All of the attempts after demand has emerged did not go anywhere. That's the result of that demand emergence. So therefore, still weaker. And our main deduction is going to be still bearish. Therefore, shorts. How do we establish a short position here? I mean, the price is just cascading down. Could you maybe also deduce from the aggression of the moves to the downside that we're going to have some kind of continuation here? And if that's the case, then, if we're cascading down, could it be maybe a trending down day? If this is an intraday? Would the high of the trading range be the supply line or the axis line? The axis line would be in the middle, Eric. And then the supply line or the resistance, would be at the top. Okay, so any ideas as to how to enter this trade? We can go short on an up day each time it goes down with up thrust. Okay. Yeah, I mean, the most simplistic thing is just, okay, here's the selling climax. Here's your low levels. By the way, excuse me, minor sign of weaknesses here. Sprint types, right? Sprint, that fails. Sprint did not fail yet. But definitely, you know, after the sprint, we want like almost immediate show of strength that continues into the sign of strength into the resistance and overcomes that. And we don't have that there. We don't have that there. You could establish a short right here. This is a little bit too far away for me, my preference. This is again a local sprint. I would say like if this sprint fails right here at this level, most definitely gonna retest this and probably will fail again because this looks so weak, so weak. So weakness here, aggression here, weakness here. Look at the change of behavior. There is nothing substantial there. Yes, demand is coming in, but it doesn't even produce a meaningful change of behavior. Failure, 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 failure. So this is the last sprint. If it fails, we're gonna go down. Okay, so that's the trade. Okay, here it is. So you could enter even prior to that at the close. Look at this volume spike, something similar to what we've had before, suggesting what? Suggesting some presence of the demand. This leads to the change of behavior. This leads to a trading range. Okay, great. So we are there. Let's make kind of like a determination for this trade that until we see a true change of behavior, we are not going to close this position on the first rally up. If the true change of behavior, which is bullish change of behavior, is going to happen, then we're going to close on the secondary test at the support rather than at the climactic action. How about that, guys? Right? So that's like a very simplistic strategy that we're going to use here. Now tell me, is this change of behavior bullish, or is this telling you that the change of behavior is weak and there's going to be another continuation to the downside, obviously? So something similar to this. Okay, weak, bearish. Yes. Are we holding this position? Are we still holding this position? Okay. All right. So everybody's saying yes, redistribution, holding for buying, diminution volume. Okay. All right. Is there a point of entry maybe here somewhere? I mean, could we enter somewhere here again? I mean, if there's going to be some kind of continuation. I mean, we should notice that the aggression now is subsiding. It's not as aggressive to the downside. So we're probably thinking, and look at the, you know, the volume spike as well. So I would just say if we're going to go down, we're probably not going to go down that much, maybe the same distance as this from here to maybe like somewhere here. Another volume spike, maybe slightly lower, maybe more. It would be even interesting to see more volume here just because demand would come in. But more importantly, I think that we need to obviously, you know, improve on the change of behavior. Okay, but our point of entry, additional point of entry, is just basically the break here, because this is an attempt to sprint, and any type of attempts to sprint that fail, usually pretty good points of entry. Here it is, and look at the volume signature. Oh, this is so beautiful. Cascading down, so your trailing stop losses is basically all of this. Your exit is here. And at this point, let me ask you this question. Would we partially trim or would we exit completely? What do you guys think? Trim. What else? Trim. Climactic volume close. Might want to exit. Exit. Exit and move on. Trim. Still no change of behavior because all of the volume on the way down. Okay. I would have trimmed on the volume spike and exit where you said exit, okay? Yeah, I think, you're collecting a lot of points here, right? Don't forget that our first, position was opened here, then we added to the position, so we have 2 units. I would easily, in a heartbeat, just close one at least, close 1 unit. There is really not a big change of behavior here. So I'm glad that I think Vanessa said this. Yeah, still no change of behavior, like significant change of behavior. But we're definitely, the only thing that is really, really on our minds at this point is that the volume signature has increased so dramatically. And yet, look at the spread compared to this, compared to this, compared to this, and compared to this. What are we seeing in the downward spread here? Some kind of diminished result, right? So why would that be? Well, because behind this volume signature, maybe some buying is coming. And that's what produces that grinding down as the price goes down. Still down, still no, significant change of behavior. So let's close one, let's keep one. And I would say, where is our stop loss? Where would it be? Okay, probably, I would say either this level right here or this one. I wouldn't want to give up a lot of profits. I mean, depending on how many points this is probably going to be like 3 points. Even with 3 points here, I probably would say like, yeah, get me out, at any attempt to rally. Because if a true change of behavior comes, it's going to rally aggressively, and then it's going to retest. So the retest might happen at the higher low. So we might be exiting at the same point of time, but the efficiency of this trade just drastically goes down as time expands. Okay, let's see. Okay, so our stop loss in both cases would work. And look, this was such a great observation by Vanessa. No true change of behavior, still keeping the position. Going down, again, using our stop loss technique, and probably that's our next exit. If we would have 3 units, we probably exit once, exit twice, and then exit third time. That's what we would do. Okay, what is your current observation here? What are you guys thinking? Tyson saying better change of behavior. Okay, I'm assuming we're talking about this Tyson, right? So why is this a better change of behavior? Out of position when price goes above the axis line, longer rally. Yes, so this is the best rally. What about the demand coming in? Do we have the preconditions for the change of behavior to happen? Consolidation under the downslope in trading range on low volume. Yes, what are those, Tyson? What are the preconditions that lead or led to this change of behavior? Range bound channel, okay. What else? Something more visible, something simpler than this. Volume increase, Raj, that's very interesting. I see the volume decrease. If anything, I'm seeing this, that supply is diminishing from 1 to 2 to 3, right? I mean, the last breakdown, look at the last breakdown. Extension, extension, extension on the diminished decrease of selling. Do you see this, guys? These are preconditions to a change. This is the first change. What should we see after a change of behavior? If we were to say that, okay, preconditions were there, then we encountered the change of behavior, what would confirm a change of behavior? A trading range, Eric is saying, okay. Well, Eric, also, you were kind of talking about, a downslope in trading range here, which I don't even want to go into, but, okay. Test, and sign of strength bar on the volume. Okay, Stanislav, what about this test? Is this a good test? And what kind of test should we have, right? So structurally, we are usually discussing tests from 2 points of view. Structure needs to be a high low, and effort, the volume and specifically supply needs to go down. Do we have those two conditions for the test? High low, volume signature is going even lower. So yes, a test. So here, any type of attempt to break the downtrending resistance, the down channel, on what Stanislav said, some kind of expanding up bar with the expanding volume signature where demand is coming in. That would be probably our even point of entry. And I mean, it's kind of like an interesting structure here because Eric is saying, well, it's a trading range. And we might be thinking like, is this a terminal stop in action and then automatic rally? And then this is a secondary test. So are we in A with an idea that the trading range is going to continue? One thing, Eric, here that I would consider is that look at how long this downtrend is. Are we in the oversold condition? Or are we in the extreme oversold condition? And if that's the case, if the answer to this is yes, then could we have some kind of faster recovery? Why? Well, because it becomes a point of value for some of the traders. So I would say that it's warranted for us to go into this position even at this point if we're going to see some kind of this up bar with the increased volume signature. Then maybe later on we might have another opportunity to enter somewhere here. So this is entry number 1, entry number 2, and then our trading range forms like this. And maybe this is our phase C, this is our phase A, this is our phase B, and then D. So we might be already in the trading range, but out of the deep oversold condition, we probably, could go up. If we are rallying, by the way, what would be the target, guys? Probably somewhere here, right? This is where supply has increased. So we would be thinking that this is where supply is going to come back and try to reassert itself. And we have quite a lot of room here to trade. So we definitely should be establishing this position. Let's see if it's going to pull us in. All right, so here is that sign of strength bar that I believe Stanislav was talking about. Increase in the demand volume signature up bar with the increase in up spread comes after the diminishing selling, after the diminishing result to the downside, after the emergence of the demand, after the change of behavior, after a good test on lowering of the supply. And then we said there might be some kind of other opportunities. So here's one, here's a second point of entry. 1, 2. Would you say that this could be also a potential point of entry here? Some demand is coming in. Okay, let's make it number 3 then. Okay, we're fully loaded. You know that I'm trading in 3 units. It doesn't really matter. 1 unit could be 10 contracts, could be 12 contracts, could be 20 contracts, or a certain number of shares just in 3s. Okay, so Is this the better rally from anything that we're seeing? Yes. Do we see the emergence of the demand? Yes. Do we see the increase in the spread, in the upward spread? Yes. Did we see the conditions of selling to deteriorate? Yes. So it seems to be like it's checking all of the boxes. Okay, and here is the solution into the end of the session. So we probably still have an opportunity to add here. This was a pretty easy kind of like move to the upside. Demand is definitely in control all the way. Into the area of the first breakdown, nothing really happens. The price just goes through. So what does it tell us? Still bullish, and this still suggests continuation, this strength. Next breakdown, we're finally experiencing something, but is it really that damaging? It doesn't damage the uptrend in stride. Supply is coming in multiple spots, but yet we're not reacting to the downside. Still continuation, still bullish. And then the next breakdown, and here we are most definitely seeing already some kind of deterioration, especially on the last number of bars. And we're thinking, yeah, there's going to be some kind of reaction, but supply is not that strong, so I would be thinking that after the reaction, continuation again. And here we go. So coming back to the whole idea of, like, 8 data points and then 100 data points, and then 8 data points times 10, 100 data points times 10. So then the weight of evidence is extremely important. The correct observations and I must say that observations of the certain points on the chart, which is maybe some points that are extremely important, is essential. And that's why the flashcard, this is the idea behind the flashcard analysis. We're looking at specific ideas, specific concepts, and then we're coming up with some kind of bias, for out of those 1, 2, or 3 points. And all of that we will be studying, obviously. For those of you guys, and this is already appropriate at this level, I didn't want you to take this class once, at the level of the WTC1, but now you're more versed in our methodology, you're more versed in our adaptation of the Wyckoff method, you're more versed and skilled with observations and deductions. Wyckoff tape reading lab would be appropriate at this level. You don't have to take it as you're taking WTC2 class at all. I would even be thinking, like, getting into the routine of WTC2 class first, establish your homework exercises, and then after that, you could consider signing up for the tape reading lab. Now, the tape reading lab is a very interesting class. We don't necessarily conduct it with William in the way how I'm conducting this class, right? So there is no discussion with students. It's more discussion among ourselves. So you have to extract the information there. So again, you kind of have to make sure that you're at the specific level there. Mondays at 9 a.m. Pacific. So check it out. All right, now let's do the bias game. Okay, so one question on the tape reading. I would recommend tape reading lab to my fellow students. It's really help complement WTC material for me. This comes from Jim. Yeah, absolutely. The only thing that I'm adding to this is that, yes, it's an appropriate level right now for you guys to take this class. Yet, if you feel uncomfortable with what we've just done, then I still would like you to stay with WTC2 at least for the semester and then go, right? So something like that. Okay, bias game. We are at 5:20, so we're probably just gonna go through one bias game here. Actually, interesting. Should we do it like that? Should I? Yeah, maybe we'll stay a little bit behind, maybe like for 5-10 minutes. Okay, so what are your major observations here about this trading range? So just give me anything that you see. And I'm just gonna start here. We are from left to right in the downtrend. Then it seems to me like we are producing the stop in action, producing the automatic rally as the change of behavior, secondary tests, phase A, and we are in the trading range. Let's solve this as a flashcard. How about that? Here's our axis line. And that way it will be faster and easier. Okay, so give me just your one main idea why it is a bullish bias or why it is a bearish bias. Let's do it this way. Michael is saying failure to overcome the sell-in zone bias is down. So where is it? I would say, Michael, that the sell-in zone for us is going to be associated with this bar right here, right? So first of all, look at the volume signature, the highest volume spike there on the supply, and it's breaking down. Okay, so let's kind of work with this. Let's work with Michael for a second here. Michael, did we overcome the high of the selling zone? At least maybe temporarily. Yeah, and Michael just said temporarily. Yes, so look into this, look into this, look into this, and then slightly here. Is this more bullish or bearish? I mean, 4 times the ability of the price to overcome the high of the breakdown selling zone and stay there for some time, stay there for some time, stay there for a long time. Michael, what do you think? So we're not really being rejected immediately, right? Or we are not failing around this high of the selling zone with the emergence of the supply or re-emergence of the supply. Okay, yeah, we'll talk about the last lower high. Okay, then I see another point here. So let's just say one idea, overcoming selling zone resistance multiple times. Secondly, somebody right away said, I think it was one of the Erics. Oh my gosh, both Erics. We have 2 Erics here, Eric C and Eric P. So one after another, and I kid you not, in the chat. First, Eric C is saying most of the trading is in the top 1/2 of the trading range. Look at that, right? So everything is in the upper part of the trading range. Okay, majority of the time the price spends there. Eric P, right after Eric C, is saying spends most of the time in the upper half of the trading range. What's going on there, guys? Are you sitting together? Oh, this is funny. All right. So what does it tell us? I mean, yeah, twins, exactly. Okay. Majority of price action is in upper 1/2 of the trading range. Bullish or bearish? Both of those, by the way. Bullish. Okay, right away, whenever this happens, my next thing that I want to see is how quickly do we recover from the points of commitment to the downside below the area where the price spends the majority of the time. How quickly do we recover from the selling climax? How quickly do we recover from a possible spring? And how quickly do we quickly recover from the last time that the price tries to commit to the downside? Is it almost immediate recovery, or does the price spend a lot of time below? Almost immediate. Okay. Is it bullish or is it bearish? Okay, you guys are saying bullish. Why is it bullish? Let's just explain this, right? When the price goes down, this creates value for institutions. And if they see value, they react to that by buying. If that's the case, then there is value at this level. And in 3 instances, by seeing that value, they come in and they start buying, they start buying, they start buying. Okay. All right. What else? Okay. Even just based on this, I mean, maybe we'll discuss a little bit more in the next class, like this, this lower high is the concern, just a minor sign of strength. I mean, when we look at the constitution of the swing, we're definitely seeing some volatility into the end of it. The recovery is pretty stable. There is nothing there. I mean, demand is just in control. Then volatility comes, and then we have some kind of attempt to shake out. And this looks like something unnatural to this particular stock. Why? Because if there is so much supply coming in and there is so much volatility, why doesn't it go lower right away? Instead, it creates a higher low. So it could be a market-driven event there, possibly COVID. You could also say, well, effort versus result. How? Well, effort is increasing to push the price down, and yet we're creating a smaller result with the higher low. Okay, so all of that, here's our flashcard solution. Just major ideas there. Let's say 4, right? Effort versus result on last higher low, which is short-term bullish. Okay, so bullish, 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 bullish. Here's our solution. You have multiple points of entry here. You could, and this was an actual stock that I was trading, was the hedge fund. So you could potentially enter on this bar, potentially enter on this bar, this, and then stop. Stop before you hit the resistance. You don't want to accumulate the stock further up. So this is your area, a zone where you would be entering this position. Okay, and then our labeling here is selling climax, automatic rally, secondary test, up thrust action, multiple times, by the way. Spring, local spring here. Last point of support, just because this is a higher low. We are seeing an increase in the volume, so it just suggests that they are coming in, institutions are coming in. Obviously, I'm one of them behind the whole pack. And this seems to be a bullish formation with the major sign of strength developing. Look at how we are extending above the points of the resistance. This is a pretty big extension right there. And look at this bar, just the beauty here. And look what is happening with the reaction. Supply is diminishing. Does that look bullish to you? While you're thinking, Tyson is saying, does volatility in the later part of the trading range indicate a reversal of the background, opposite of decreasing volume continuation? Tyson, the thing here is just look at the timestamp, right? So COVID, the reason why volatility has increased in this area is because of COVID. But also think what COVID did to the market and other stocks, right? And what this stock is doing. Instead of going below the spring low, below the 2019 low, it actually stops as a higher low. So this is a pretty strong stock. So in terms of the selection, you would be begging for this type of stocks, to come to your radar at this point of time. So I thought at the time this was a great point of entry. This is a great stock. There is a huge causality, multi-year causality. That's exactly what we wanted to do with all of our positions in the hedge fund, cash positions, long-term ideas for the business cycle. And this was perfect. Okay. Now, we are continuing with bias game number 170. Same stock. This is the daily. So here we were looking at the weekly. This is the same stock daily, right? So here's your COVID. We're seeing how here, look at the diminishing supply and a very, very high test. So this distance between the low and the low of the test, the low of the last point of support and the low of the test, there is a lot of space right here. So pretty strong. So all of this is just buying, 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 buying. Okay, let's analyze the last trading range. And I could make an argument here that, let's say like this is a buying climax. This is where supply is coming in. What does it produce? It produces this much of the change of behavior. You could be thinking about like, okay, this is the trading range right here. Or you could be thinking, this is the trading range right here. And however you're thinking about it, what do you think about the volume decline with the background, which is up? And what do you think about the retracement after the rally into the buying climax? What are you thinking about the downward spread relative to, let's say, this downward spread here? What are your thoughts here, guys? Everyone has already bought and is holding on up. Okay, what else? I need more. Seems strong. Okay, what else? More observations. Bullish. I'm suspecting somebody has been following the Twitter bias games. Low volatility, the low volume threw me off, I guess. I thought it was going to stay in moving up. Downward reaction is weak. Yeah, okay. In short, there is nothing threatening here. This is a very small retracement to the rally that we have, the rally that is undeniably having demand being in control after a very volatile event on the background of outperformance over the market, over the general market, and over so many stocks. Is this a good stock to be in, especially if you bought in, let's say in this area right here? This is your buy zone? Absolutely. So you're holding on, your stop losses could still be here or somewhere below where you bought in, right? Doesn't break the sell-in bias, the buying climax bar from Thomas. Yes, absolutely. Barely below half of that bar. Yes. Okay. So this is what happens next. Dramatic pause. Now, remember, I was trading this. I was trading this with the hedge fund, and we've been accumulating this position on the way up. So when we went into the close, I mean, obviously, I'm not doing anything at the open as a hedge fund manager because you cannot react right away to the event, right? Yeah, bad news, yes. But you have to see what kind of close we're going to have. And this was a pretty quick, in the morning type of, move to the downside. So definitely under all units. So this is that black swan event that sometimes happen, right? So those gaps that go against you, you could now even guess what kind of company this is in terms of the, belonging to a specific sector or a specific group. Yeah, biotech, pharmaceuticals, and here's the result. I mean, we could definitely talk about how you handle this. There are ways of handling this here, like how do you handle first idea? How do you handle, let's say, exiting the position, trimming the position, staying in the position? And maybe we'll discuss it in the next class, right? Okay, so that's number one. Secondly, how do you handle the risk? And this is the key word, before this happens, before this event. Okay, again, we could discuss both of these points in the next class. Just remind me about this next Tuesday, and we'll definitely go through this. But that's what happens. And I'm just saying, in my personal message, in the bias game, is that it doesn't really matter sometimes that you do your analysis correctly, that you see that bullish bias, that you establish the position, that it goes in your favor, and then something like this, some kind of catalyst comes, specific to this particular company, and then unexpectedly it just breaks down like this on you. It happens, and that's why the whole idea in some of the people's minds that I work with, that, oh, I'm gonna get so good that I'm gonna be correct all the time. It's a great idea, but you will not. You will fail, and these failures are essential for your growth as a trader. It has to, this type of failures and other failures have to get you into the mindset that market is uncertain. Anything could happen. You do not have the control of the market. The only control that you have is what you do. How do you position yourself prior to this trade, to a potential risk event like this? How do you protect yourself? What do you do when this happens? What do you do prior to this happening? Because if we would be in some kind of stock that would be weaker, maybe we would be trimming already this position. And we did, take some profit here, but it was not, substantial at all. It was less than 10%. So it was kind of a cool bias game for me to show you guys that anything can happen, even if you think that analysis was absolutely correct, which I thought was the case. It looked extremely bullish. It looked as the stock was outperforming during the COVID event, recovering pretty nicely. Everything was on the table there. Causality, the also the group, the recovery stocks being in the group that really sticks out, on the winning end. And here we go. Yes. Good to hear about failing. I'm there on the past few games. Okay. Great lesson. What was the news? The news was related to the specific FDA approvals, I believe. If I'm not mistaken, I would have to go back and double check. But with all of the pharmaceuticals and biotech, that's what usually is. That's kind of like the biggest news. Okay, so in the next class, we'll discuss how I dealt with this situation, how we dealt, or rather, with this situation. How could we project the risk before we actually open the position? We'll talk about the specificity of that particular industry group, like how do we actually, assess the risk relative to this type of, mini black swan events? How do we protect ourselves? Okay, meanwhile, your homework is the bias game number 173, and I will add another bias game, which is we didn't do in the WTC2 class. I believe it's going to be 171. So your homework is, okay, sorry. Your homework is to read these two articles and then to do the two bias games, 171 and 173. And I'm looking forward to the next Tuesday, next class. For those of you who are guests, again, I'm going to repeat myself here. Well, first of all, this video will be posted on our YouTube channel, Wyckoff Trading Method. So check it out if you want to kind of like go make some notes, rewatch it. If you feel like, yeah, you want to be a part of this education, you'll have to start with WTC1 class, which we've conducted yesterday. You could find the copy on YouTube channel as well. Shoot us an email to wyckoff@gmail.com, and we'll be happy to address any questions that you have. Nancy could address any administrative questions, and I could address any content-related questions. So with this, guys, looking forward to this new semester, looking forward to, as usual, work, right? That's us. We work on our craft. We don't just talk about this. We develop deep knowledge and we develop, high level of skills. That's who we are as a group. And therefore, expecting fully your compliance with the mandatory reading assignment homework and with the bias games as well. And then in the next class, we're just going to add to that anatomy of the trade, and we'll go from there. With that, thank you guys so much. Good start, and I'll talk to you next Tuesday. All right, thank you. Bye-bye.